For more on what this could mean for the markets, let's bring in Marianne Bartels of Sanctuary Wealth. She is the chief investment strategist there. Marianne, welcome back to the show. Great to see you.
Thank you for having me.
What do you think of staples?
They're not trading well at all, which is really interesting because normally your defensive sectors trade really well when you're getting a pullback, and they're not trading well at all. Really, what's trading well is the leadership. You know, it's the tech, comm services part of the market that's holding up the best, which tells me this is just a correction.
So you want to stick with that leadership. You like semis, you like the big cap tech.
I do. I do. And it's hard because I'm in the business for 40 years. I've studied the history of the markets. And normally when you get a very concentrated market, that's a warning sign. But if you really look at the whole structure of the S&P, it's a problem across the whole sector. The other thing is we don't have as many stocks that used to trade. We've lost like 2,000 stocks. And you're really starting to see private equity really play a pivotal role in actually funding companies. So the whole structure of the market has shifted since 1985 when I first came into the business.
So, Mary, great to have you here on our new set.
Yeah, it's fabulous.
So let me ask you, what would make you change your mind about sticking with the ones that have worked, the tech and the communication services? Is it a valuation, or is it some sort of structural change in the market or rates that would make you change?
So I think the first sign would be technical. You probably all know that I did spend part of my career as a technician. I think the first signs would actually come in the relative performance. And what a lot of people don't realize is the S&P 500 technology sector actually hit an all-time new relative high back in July. If that leadership was to start shifting, that would be my warning sign. Everybody talks about valuation, but valuation is not a very good timing tool. In fact, when I'm looking at the overall PE of the market, in another life, I was a quant, and I'm using some quantitative measures. We normally don't talk about them because they probably scare people. They're things like called logarithmic scales and z-scores.
Guys, look at the guy's face right now. He's starting. Yeah.
And when you look at those that kind of matrix on a PE, the markets are actually cheap. And that was something that was really shocking to me. So I don't think the markets are as expensive as they appear to be. And I think we could go into a super cycle for growth stocks. That's one of the things that I'm monitoring. And if we do go into a super cycle for growth stocks, you're going to see PE levels that will curl your toes. We're not even there yet.
That sounds painful, by the way, Carl. I mean, having broken a few myself. So, Marianne, it's great to have you. So, Procter & Gamble's a big component of this, as well as Costco. Both stocks have done okay, but Coca-Cola and Pepsi, which are two of the top four, have absolutely rolled over. I think it's because margin compression. That has to be a concern that, as Tim said before, they can no longer pass on their costs to the consumer.
Now, here's something else interesting. I was looking at margins just based on the S&P 500, and there's something that's called the rate of change, but then there's something that's called the rate of change of the rate of change. It's called the momentum or the second differential. Profit margins are actually starting to improve. I'm watching, we had PMI manufacturing numbers today. They look like they're actually bottoming. So I'm always looking for what are we not talking about? Well, what if we are having a reacceleration in the economy? And that would get to Rick's point that rates still have to back up.
So you're calling for a real pickup in the economy, a super cycle for growth stocks.
Did we just have that?
No.
I mean,
are you lonely?
We haven't been in
I'm very low. I'm definitely I'm in the lonely camp. Definitely in the lonely camp.
So where are rates during this whole super cycle?
So when Rick was on earlier, he talked about rates going to 13.5%. Okay, so when you look at the cycle of interest rates, they normally go 20 to 30 years. We ended a 40-year cycle, and we are now in a total new regime for interest rates. And what we've been telling clients is that you will see rates at least at 10% in your lifetime. This is about timing. I think the 10-year gets up to about the 5% area and backs off. I think twos don't go up too much more. You don't want to time it until you actually see it peak. I thought rates were peaking a couple of months ago, and I was wrong. So I agree with Rick. It's really kind of hard to time. But I do think the cycle for interest rates over the next 15, 20 years is higher.